Closing thoughts. Stocks are already pricing accelerating growth. The bulk of the returns in the last 12 months have come from valuations going up rather than earnings going up. So this year, for example, earnings are going up 10%, but the stocks are up 25%. So about 15% of that return has come from valuations going up, not the ideal source of growth. I think the Trump trade provides plenty of opportunity, and there's also risks. Small caps are the clear beneficiary because they're very U.S. centric, don't have overseas exposure. Can large cap performance broaden where because of the sector rotation that is already taking place, as Alex pointed out, financials have done particularly well in the last few months and since November. Lurking risks that are being ignored. Higher inflation, tariffs are a real unknown, alongside the prospects of better growth. And the deficits, I usually don't use the word that, hey, deficit, something is going to happen. But one area I feel confident saying is like deficits and the need to, for the debt to grow, the US debt to continue to grow is an area that will continue to go along. And, inflation as a result becomes a real issue. Last bullet point will be, TIPS, which are Treasury Inflation Protected Securities. So these are government bonds or treasuries that go up in value along with inflation. Those, we think are pretty attractive. Small cap valuations are attractive, and we'll talk a little bit more in the next slide. And do you use other assets to hedge against deficits and the rising debt that the US is likely to face? And here's a summary and the top investment ideas. There are going to be clear sector winners within US stocks with Trump, the administration and its policies. You're already seeing some of that. Financials offer stronger growth, or the stronger growth in the economy is good for loan demand. The yield curve is steepening. That means longer term rates are going up, and that meaningfully improves the profitability of banks. We also think more IPOs are going to come through in 2025 with deregulation. That helps the banks. And they're very US centric, very little exposure to international. Industrials are another sector where reshoring, and I think this is a bipartisan theme where you're going to have companies trying to reshore. You need more industrial goods. And same goes for electricity demand for AI, which is very industrial heavy. Some of that also falls into the energy space where the real source of electricity or the fuel for electricity on a 3 to 5 year view is going to have to be natural gas. So you can play the volume growth in natural gas. That's going to be a very good area. The areas that are more questionable is tech because they get a large percentage of their earnings from overseas. So geopolitics at play. Consumer companies that rely on imports. What happens if there is a fairly substantial tariff? Inflation or prices go up, that should reduce the demand. And then pharma with RFK Jr., that opens up a whole bunch of risks in the pharma sector. If you look at returns since the election, the only sector that's down is pharma. And, I think rightly so. We talked about inflation. I think, one of the things we like is TIPS, Treasury Inflation Protected Securities, as an augment to your existing bond portfolio. And that's an area because this will give you inflation protected yields in the coming years. We touched on international stocks. We are underweight. We remain underweight after several years. Valuations are really attractive, but we need a weak dollar. And there is no sign or nothing that I look at that says that the Trump policies will be anything other than good for the dollar, that the dollar is going to continue to be strong. That's the primary reason that we are not proactively allocating to an area that's clearly attractive on a valuation basis. Mid and small cap companies offer much purer US only, US economic exposure. So that's the positive. The valuations are also attractive in the small cap space. The one negative is that if inflation stays higher, and there's risks of that, and rates stay higher, the small caps are going to be impacted because they do not have access to bond markets with fixed rate borrowing costs. So that's one of the things that makes us neutral there, but something to clearly watch. And the last point would be, hey, deficits are here and increasing for the long term. The deficit, as far as I can see, is going to be more than $2 trillion, and with that comes the need to perhaps have some hedge in your portfolio. And the question is, things like gold or assets like gold, Bitcoin, are they strategic hedges for your overall portfolio? So that is the end of my presentation. We have time for Q&A. Please add some into the chat box. Thank you for those of you who had already provided a few questions. And over to you, Alex.
Yeah, thank you, Asi. That's a lot of information. I know I say this all the time, even though we prepared for this webinar together. I always learn something new. So I feel like this is really good. So we have several questions that were actually submitted to us prior to the webinar. We can pretty much address most of them, but I guess we should prioritize the ones that are submitted by the participants. Here's one of them. Again, I'm just going to read the question. I'm not going to mention this person's name. What's your opinion on nuclear power in the future? Asi, I'm pretty sure that's for you.
Yes. I am very, very bullish on nuclear power. Uranium is an investable asset, which it did particularly well last year, went up almost 100%. It is, I've said, probably flat to down a little bit this year. The problem with just nuclear power is it is going to take us a decade to get the next set of power plants in place in the US. And you're seeing some restarts because Amazon and Microsoft have gone and contracted directly with plant owners. You need base load, always on power for the data centers, AI or otherwise. And at the moment, this is the most reliable and the lowest cost source of energy. It just takes a long time. If you want to look at uranium, then you got to look at the rest of the world because China is adding a vast number of nuclear power plants. Lots of other countries are also adding, countries like India, Korea, that are adding or have plans or have announced plans to add nuclear power plants. And there has not been much investment in both, on the uranium side. So there's probably going to come a time where the uranium price reacts quite positively to all the higher demand.
So. Yeah, that's pretty much matches my thoughts, but you gave a much more elaborate answer to that question, so I'm not sure if I have much to add. Okay, so the next one was actually submitted to us prior to this webinar. I guess more of a practical question, I'll say. Federal employment in the Washington, D.C. area. Do we anticipate job losses or relocations? What are your thoughts, Asi? I mean, I can definitely have some thoughts, but please.
So I have a thought on a couple of things. I think the new administration goes 5 days a week in the office. That perhaps leads to natural attrition. But more importantly, the commercial office space or commercial property, office property in DC is one of the worst in the country. And I think the return to office of the federal employees is going to be quite positive for that space. So I think more natural attrition, given what we have heard briefly from the Doge Council, whatever you want to call it. Their goals are to reduce the size. I'm not so sure that they will be successful, but my I think my one takeaway would be that it's good for office properties in the DC area.
Yeah, so I will I see. Yeah, so I will give I guess a slightly different answer, maybe a partial answer. So I'll start by saying that a good quarter of our clients, of our existing clients, are either current or former government employees. So this is certainly a concern of ours, and of course, we're located in Maryland, specifically in Rockville. So just over the past 2 months, we had requests from 4 new clients. These are brand new clients. We never worked with them in the past, asking us to evaluate their early retirement options. So I'm not trying to, again, induce any fear or anything of that nature, but if that's a concern to the person who is, asking this question, this would certainly be a good time to prepare, because again, a lot of people are, considering what would happen if, there are cuts in that field. Okay, we have 2 more questions. Actually, 3 more questions in the chat box. So I'll read this one. TIPS purchases. So again, TIPS are Treasury inflation protected securities. Individual bonds or through funds/ETFs? What are your thoughts, Sim? I guess the question is, what's the best way to allocate in the form of individual or
Yeah,
ETFs?
I think it's, it depends on the portfolio you're trying to craft. If you want kind of a bond ladder, and I'll let you explain that, Alex, but type setup, individual tips makes the most sense. But if you want a broad allocation, doing it via the person asking the question even says, a couple of tickers, right? You can allocate it through an ETF, and which gives you the ability to kind of more tactically take a view, and if things change, you can then more easily move that large part. I don't know about more easily. It's just easy, right? Owning an ETF versus actually owning a individual bond, which many individual investors may not want to do that, because it's slightly more difficult to do it through your brokerage or whatever interface you use.
Yeah, so I'll just add on our end, we use both options. As I'm thinking here, it's probably not a dramatic difference between the two. I will say this: if we're building a bond ladder for our clients, meaning that we actually need to match it with their actual cash needs or actual portfolio distributions, would most likely prefer individual bonds, because we have access to a lot of them on our institutional platform, and we have essentially more control over their maturity. So 1, 2, 3 years, and so on and so forth. If you're mostly doing it for asset allocation purposes, right? Perhaps per our conversation, per our discussion today, then the ETF version is probably even better, because you don't have to deal with buying individual bonds. But I believe both are perfectly fine, for doing this. Okay, the next question here: when high yield savings accounts have rates that seem to match or exceed bond rates, why invest in bonds instead of putting that money in a high yield savings account where it can grow and would be more liquid? Asi, please.
Oh, you want me?
I'm happy to address it, but if you have any thoughts.
So high yield savings accounts are linked to the short-term interest rates, and just in the last 6 months, it's come down 0.75%. With the bond, especially if you're owning an individual bond, you can lock in. So high yield savings probably gives you 4.5, 4.75 max today. You can buy a bond, say, lock in that rate for 5 years. You can go and buy a bond and lock it in for 5 years. So in the next 6 months, if the Fed cuts rates to 3%, your high yield savings account is probably going to give you 3%, 6 months down the road. And instead, you've locked in 4.5 or 4.75, whatever you lock in. And if you do it through an ETF, it's equally easy, bond ETF, equally easy in terms of liquidity. And I would argue, if we build bond ladders for clients, bonds are very liquid. It's I realize it's not as easy as dealing with your bank, but in the right hands or right operators' hands, bonds are as liquid and as a high yield savings account. So that'd be
Yeah.
my answer.
So my answer, I'll just add to that. I happen to agree with you pretty much 100%. I say, so my first kind of like follow up question would be, how much money are we talking about? If we're dealing with your cash reserves, as an example, and we usually recommend that our clients keep anywhere between 3 to 6 months of their regular expenses in cash, then I would certainly take this approach. Have a high yield savings account, and that's pretty much that. Now, if we're dealing with larger sums, let's say someone is saving for a down payment, as an example, or some other large purchase, then at least to my knowledge, and I don't want to claim that I've seen every single high yield savings account out there, I believe most of the time you can actually get a better yield out of short-term treasuries when compared to high yield savings accounts. Again, I'm sure if someone wants to do a deep dive into every single, bank or credit union, you'll find a better option. The second option is very important, especially in a place like Maryland, because when you buy treasury bonds specifically, there's no state income taxes. That's a big deal. That's a pretty big deal for, many of our clients are in a higher tax bracket. So in many cases, when I explain it this way, that usually kind of tips it in a certain direction. So that's my answer to this question. Okay.
I'm going to add one more comment. If you are being offered a high yield savings rate that is meaningfully higher than what the US government is getting, there's risk there. I'm not sure how they're getting, offered. I'd be, I'd be I would question the sustainability of that higher than bonds or higher than Federal Reserve rate interest rates. So it could be a red flag of a bank that needs the liquidity. Yes, it is FDIC protected and all that, but it's usually not possible to offer on a sustaining basis rates of return or interest rates that are higher than where the government borrows at.
Okay, here's a follow-up comment slash question. We addressed it earlier. 5 days a week return to office question mark. I believe that relates to the question about federal employment situation. That seems impossible. We expect 3 days return at most. Do you have any comments or thoughts on that?
I mean, I would. It seems like the person has some inside knowledge. I would say I'm skeptical of the effectiveness of this Doge Commission group, whatever you want to call it. Um, the the government, each department, everything comes with a very strong union. There are ways of doing things. There are rules about how you can um, uh, interact with the working rules and conditions and the collective bargaining. So I think it's going to be quite difficult to will certainly come through with the cost savings that they claim they will do because they're like, oh yeah, we're going to reduce the this is a different question. They're going to reduce the deficit by trimming government expenditure. I think that's a total red herring, is not going to happen, or we will continue to borrow more and spend more. Back to your, I'm no expert on the 3 days versus 5 days. It's just the idea is that they're going to get people back to work. And even if it's going from, 1 day to 3 days, 2 days to 3 days, I guess my conviction point was that it'd be better for the beleaguered Washington, D.C. office market, where you're seeing quite a few failures of office buildings. As I understand it, close to or maybe slightly more than 50% of the office space is rented by the federal government.
Wow. Wow. Okay, so
That's
we have a few more questions that, again, were submitted to us prior to this webinar. And you touched on this, Asi, and I will read this question, then I'll put a little bit of a spin on it. So, outlook on international investments given Trump's trade and China policies. So again, you touched on that, and perhaps we can go a bit deeper. We have a little bit of time, but I'll ask you this. We do know that a lot of the market movement or market performance is driven by the sentiment. Sometimes it's not logical, but it's just what people, perceive it to be, specifically on the retail side. So if those large tariffs are actually imposed, would it make certain companies outside of the US essentially uninvestable? Or am I taking this too far? What are your thoughts?
Certain companies are uninvestable. I mean, I'm a couple of things. Let's unpack it. The US is the largest global market. It also happens to be the most robust, certainly over the last 3 to 5 years, compared to the European economies that are struggling. China is in a deflationary recession, so that's in deep trouble. So I think you've seen the markets react, and I would point to the foreign currency markets, which are not very retail dominated, very much professional investors. The US dollar has strengthened against almost every currency. That's anticipating higher tariffs, lower flows, and struggles for those overseas economies. And my overall kind of macro analysis is overseas stocks are already, given the low valuations, are not expecting much growth. Right. So okay, a little bit less growth, fine. It's already in the valuation. But historically, for international stocks as a whole to work, you've needed a weakening dollar. And this current policy setup, I mean, it's almost impossible to argue that it's going to lead to a weaker dollar. It's, almost everything points to, hey, it's going to be a stronger dollar. It's gotten stronger since early November. And so, yeah, I mean, a little bit less growth in international stocks. Yeah, it's already priced. That's why they're near historic low valuations. So, but, we could have had this argument a year ago, as I said earlier.
Yeah.
It was attractive relative to US stocks. It's like if you only looked at valuation, you'd go buy international and you'd have left, what is it, something like 20% on the table so far.
That's right. That's right.
Those are meaningful numbers. So I spent, I've lived and worked investing overseas for 12 years. I spent 25 years investing in global markets so this is and this is my wheelhouse, if you want to call it that. Despite it being my wheelhouse, or because it's my wheelhouse, I see very little reason to go, be overweight international stocks. There will come a time, I don't know when, and this could, as you saw in the early 2000s and in the 90s, the international stocks massively outperformed the US market. But I'm not sure when that's going to happen. When the time comes, we will, it's our duty, our fiduciary duty to our clients. We will try to make that move to benefit the client portfolios.
Of course.
It's not just yet.
Well, and this is perhaps where that's the not the right industry for us. But if you really believe that the US dollar will get much stronger, perhaps this would be a good time to at least think about traveling outside of the US, because that would certainly help you if you're trying to travel more, like places like Portugal is an example. I remember we had clients who traveled there and they had like lavish dinners and such for a relatively small sum. So, okay. So I guess one more question, and on purpose, I kept this, simpler question, perhaps not so much to the end. What investments are safe today? That's the question. What are your thoughts on that?
Sorry, are safe or are not safe?
Are safe. What investments are safe today? Question mark.
I mean, look, it runs the gamut, right? And time horizon. We had a question about high yield savings account. Very safe. Um, you can buy U.S. government treasuries, and I would say it is never going to default on you because the U.S. government can always print money and pay back the amount. They may, but if that's on a 1 year horizon, those are very secure and no issues. Like you're not going to lose dollar amounts on a nominal basis. If you ask me that question about a 10-year view, owning or putting money into a high yield savings account or into a US government bond, I think you're going to lose money on a purchasing power. Like your purchasing power in 10 years is going to be less. If you put $100 into a high yield savings account or into bonds, the what that $100 buys today, it will not buy in 10 years. So, that's what we tried to balance out. Uh, if you use safety as volatility, you know, the volatile aspects are hard because over a 1 year period, it could fall. You could buy Apple, it could be down 20% on a 1 year basis, but you have much higher confidence that in 10 years, it is going to give you greater purchasing power than buying a super safe asset. And that's kind of the trade-off. And you can take the cash and keep it under your mattress, super safe, not going to lose any money, but also for as retirement planning specialists, that's probably the worst thing because you will not, if you do that with a large portion of your portfolio, you're going to not be able to sustain your income needs.
Well, see, again, you explained it so well. That's usually what I say, like in our intro meeting, specifically with our newer clients. And sometimes people look puzzled at me, and I say, look, bonds or any other fixed income investments are safe in the short run, and stocks are safe in the long run, and vice versa. And it usually takes people a little bit of time to really connect the dots because there's so much of this rule of thumb analysis. I'm not going to go into much of that today, which I, by the way, very much dislike. When people decide that a certain portion of their portfolio should be in bonds, usually a large portion, just because they're, let's say, older. And in many cases, again, that is just not the best approach. All right, so yeah, we're gonna save everyone 3 minutes. So again, thank you everyone for joining us today. I hope you found this webinar helpful. Of course, if you have any questions, feel free to reach out to Asi or myself. You can see our contact information on the slide, and we will release the recording with the slides in our newsletter next week. Again, it's every Wednesday at 7:30 a.m. Eastern. Thanks so much, and enjoy the rest of the day, and happy holidays.
Thank you, guys. Appreciate it.